Happy New Year! It's January 2026. While most people are thinking about fresh starts, market forecasts, or where interest rates might go next, something far less obvious is unfolding quietly in the global economy. Silver is trading near $70 an ounce. Just a few years ago, that number would have sounded extreme, and yet, despite one of the strongest runs in silver's modern history, there's something unusual about the mood surrounding it. There's no mass excitement, no mainstream obsession, no sense of panic or euphoria, which leads to a strange and uncomfortable question. If silver prices more than doubled in a single year, why does it still feel like no one is paying attention? Normally, markets don't behave this way. Big moves usually come with big narratives, fear, greed, or headlines screaming about bubbles and crashes. But silver's rise hasn't felt like that. Instead, it's been quiet, almost mechanical. And that's the first clue that something different is happening. Because this time, silver isn't being pulled higher by speculation or monetary panic alone. It's being absorbed slowly and steadily by technologies that don't care about sentiment. Solar panels don't wait for investor confidence. Electric vehicles don't check price charts. Data centers don't pause because markets feel uncertain. They consume silver because they have to. And once that silver is used, much of it doesn't come back. So the real story of silver in 2026 isn't just about price levels or predictions. It's about a deeper shift in how silver fits into the global economy. What if silver isn't in a rally at all? What if what we're seeing is something more subtle, something structural, a quiet repricing? To understand that idea, we need to step away from charts and headlines and look at how silver's role has evolved over time, starting with what silver used to be and how that story slowly began to change. To understand why silver may be quietly repricing today, we first need to understand what silver used to be. For most of modern history, silver's identity was simple. It was money. Silver coins circulated alongside gold for centuries. Wages were paid in it. Trade was settled in it. And for ordinary people, silver, not gold, was often the more practical store of value. But as paper currencies took over in the 20th century, silver slowly lost its monetary role. Gold remained the ultimate reserve asset. Silver became something else. By the mid-1900s, silver was viewed as a secondary metal, part precious, part industrial. It still mattered, but it no longer defined the system. From that point on, silver prices were driven mostly by financial forces, not physical necessity. When inflation surged in the 1970s, silver spiked. When interest rates collapsed after the 2008 crisis, silver rallied. When central banks printed money, silver followed gold, just with more volatility. This trained investors to think of silver as gold's louder, riskier cousin. Even in the 2010s, silver's major price swings were tied to monetary policy, fear, and speculation rather than changes in real-world usage. In other words, silver behaved like a financial asset. And for a long time, that made sense. But quietly, beneath the surface, silver's role in the economy was changing. Photography, the old industrial use, was fading. Electronics were rising. Energy systems were evolving. And slowly, silver stopped being primarily something people held and became something modern economies used. That shift didn't happen overnight. It didn't come with headlines. But it laid the groundwork for everything we're seeing now. Because once a material becomes essential to infrastructure, it stops being priced like a speculation and starts being priced like a necessity. And that's where silver's story begins to change. At some point in the last decade, silver crossed a line most people didn't see. It stopped being driven mainly by investors and started being driven by engineers. Today, close to 60% of all silver demand comes from industrial use. That number used to be closer to 40%, and that shift matters more than it sounds. Because industrial demand behaves very differently from investment demand. Investors buy silver when they expect prices to rise. They sell when conditions change. But industries buy silver because they need it to function. Silver isn't used in modern technology because it's shiny or rare. It's used because it has the highest electrical conductivity of any metal on Earth. When efficiency, reliability, and precision matter, silver isn't a luxury. It's a requirement. This is a fundamental change in how demand enters the market. Instead of reacting to fear or optimism, demand now arrives on production schedules. Instead of flowing in and out, it becomes embedded. Think of it like this. When an investor buys silver, that silver can come back to the market tomorrow. When a solar panel manufacturer buys silver, that silver is soldered into a panel and bolted onto a roof. It doesn't trade. It doesn't speculate. It disappears from circulation. And this is happening across multiple industries at the same time. Energy systems are being rebuilt. Transportation is being electrified. Data infrastructure is expanding at unprecedented speed. Each of these systems uses silver for the same reason. Nothing else works quite as well. This is why recent price movements in silver feel different. They haven't been explosive or emotional. They've been steady, volatile, but persistent. That's what structural demand looks like when it collides with a slow-moving supply base. And this is where silver stops behaving like a typical precious metal and starts behaving like a strategic input. To see how powerful that shift really is, we need to look at the single largest industrial buyer of silver today, one that operates quietly, scales relentlessly, and locks silver away for decades at a time: solar power. If silver's repricing has a single dominant driver, it starts with solar energy. Modern solar panels rely on silver paste to conduct electricity across photovoltaic cells. Silver is used because it combines unmatched electrical conductivity with long-term reliability in harsh outdoor conditions. There is no substitute that performs as well at scale. On average, each solar panel uses between 15 and 25 grams of silver. That number sounds small until you zoom out. In 2024 and 2025, the solar industry consumed over 200 million ounces of silver per year. That made solar the largest single industrial use of silver globally, accounting for roughly 1/3 of total industrial demand. And here's the detail that quietly changes everything. Silver used in solar panels is not economically recoverable. Once that silver is turned into paste, printed onto cells, sealed inside panels, and installed on rooftops or utility-scale solar farms, it is effectively removed from circulation for decades. It doesn't get recycled annually. It doesn't re-enter the market during price spikes. It's gone. Now layer in global policy. China, the United States, Europe, and India are all expanding solar capacity aggressively, not because it's fashionable, but because energy security has become a strategic priority. Solar reduces dependence on imported fuels and stabilizes long-term power costs. As a result, global solar installations are projected to quadruple by 2030. Manufacturers are actively trying to reduce silver content per panel, a process known as thrifting. But this efficiency gain is being overwhelmed by sheer volume. Even as grams per panel decline slightly, total silver consumption keeps rising because far more panels are being installed. This creates a one-way demand dynamic. Every new solar farm locks away more silver. Every rooftop installation tightens available supply. And none of this demand responds to price signals in the short term. Solar doesn't stop building because silver is expensive. It builds because energy systems must be built. This is the kind of demand that doesn't create headlines, but it quietly reshapes markets from the inside. And solar is only the beginning. Electric vehicles add another powerful layer to silver's changing demand profile. A traditional gasoline-powered car uses a relatively small amount of silver, mostly in basic electrical components. An electric vehicle, by contrast, uses 2 to 3 times more silver. The reason is simple. An EV is not just a vehicle. It's a rolling electrical system. Silver is used throughout an electric vehicle and battery management systems, power electronics, inverters, safety controls, sensors, and charging interfaces. These systems rely on silver's superior conductivity to handle high currents efficiently while minimizing heat and energy loss. On average, a single electric vehicle can contain up to 50 grams of silver. That may not sound dramatic until you consider scale. Global EV sales have been growing at double-digit rates, driven by tightening emissions regulations, falling battery costs, and massive investment in charging infrastructure. In several major markets, electric vehicles are on track to overtake internal combustion engine cars as the dominant category before the end of the decade. And, unlike consumer electronics, vehicles lock silver away for long periods of time. When silver is used in an EV, it doesn't cycle through markets. It doesn't get resold. It doesn't respond to price spikes. It becomes embedded in transportation infrastructure for 10, 15, or even 20 years. This creates a compounding effect. Every year of increased EV adoption adds a new layer of silver demand on top of what already exists without releasing much supply back into the system. And this demand is not discretionary. Automakers don't delay production because silver is expensive. They pass costs through the supply chain because meeting production targets matters more than marginal material costs. As electrification accelerates globally, silver quietly becomes a transportation input, not just a commodity. And when a metal becomes essential to both energy and mobility, its pricing dynamics begin to change. But there's another sector quietly pulling silver out of the market. One most people don't associate with metals at all: artificial intelligence. Artificial intelligence feels intangible. We experience it as software, algorithms, and screens. But AI is built on something very physical: data centers. Behind every AI model sits a growing network of facilities filled with servers, power systems, cooling equipment, and miles of wiring. These systems move enormous amounts of electricity, and efficiency matters at every step. This is where silver comes in. Silver's unmatched electrical conductivity makes it essential in high-performance computing environments. It's used in advanced connectors, switches, power distribution components, and specialized electronics, where even small efficiency losses translate into heat, instability, or failure. Unlike consumer gadgets, AI infrastructure scales relentlessly. In 2025, global data center power capacity surpassed 50 gigawatts. Analysts expect that number to double by 2026 and potentially quadruple by the end of the decade, driven by AI training, cloud computing, and real-time data processing. To visualize this, imagine small cities being built, not for people, but for machines. Each one demands uninterrupted power, precise electrical control, and extreme reliability. Every expansion quietly adds silver demand. And this demand behaves very differently from speculative investment. Data centers don't buy silver because prices are rising. They buy silver because the infrastructure won't function without it. Once installed, that silver doesn't circulate back into the market. It stays embedded in hardware racks, power systems, and cooling infrastructure for years. This is why AI-driven silver demand is often underestimated. It doesn't spike suddenly. It doesn't make headlines. It grows steadily, year after year, alongside digital infrastructure. When you combine AI demand with solar and electric vehicles, a pattern begins to emerge. Silver isn't being pulled by a single trend. It's being absorbed by multiple systems expanding at the same time. And this brings us to the constraint that ultimately determines pricing, not demand, but supply. Because silver supply is far less flexible than most people realize. At this point, the demand story is clear. Solar power is scaling globally. Electric vehicles are multiplying silver usage per car. AI and data centers are expanding non-stop. So the natural question is, why doesn't silver supply simply increase to meet this demand? The answer lies in how silver is produced. Unlike copper, lithium, or iron, silver is rarely mined on its own. Roughly 70% of global silver production comes as a byproduct of mining for other metals, primarily copper, lead, zinc, and gold. This creates a fundamental constraint. When silver prices rise, miners don't automatically produce more silver. They produce more copper if copper demand rises. They produce more zinc if zinc prices justify expansion. Silver output only increases if those primary metals justify new mining projects. This means silver supply is slow, rigid, and largely unresponsive to its own price. And that rigidity has consequences. Global silver mine production peaked around the mid-2010s and has since remained flat or declined slightly. New discoveries are rare. Permitting takes years. Capital costs are rising. Recycling helps, but it has limits. Most recycled silver comes from electronics and jewelry, not from solar panels or electric vehicles. As we discussed earlier, silver used in modern infrastructure is often uneconomical or impossible to recover for decades. This mismatch between rising demand and inflexible supply has already shown up in the numbers. From 21 through 25, the silver market recorded 5 consecutive annual supply deficits, draining an estimated 800 million ounces from above-ground inventories. These deficits didn't trigger immediate shortages or panic. Instead, they quietly thinned the buffer that once absorbed demand shocks. Think of it like a reservoir. For years, silver inventories acted as a cushion. Demand could rise, supply could lag, and the system still functioned. But each deficit lowers the waterline. And when the reservoir gets shallow enough, even small disruptions start to matter. Which brings us to the next layer of the story. Not a sudden ban or collapse, but something subtler and more powerful. Geopolitical friction. When people talk about silver and geopolitics, the conversation often turns dramatic. Words like weaponization or collapse get thrown around quickly. But the real influence China has on silver markets in 2026 is quieter and far more effective. China controls roughly 60 to 70% of the world's refined silver supply. That doesn't mean it owns all the silver in the ground, but it does mean a large share of silver passes through Chinese processing, refining, and export channels before reaching global markets. Starting in 2026, new export licensing requirements came into effect. These rules don't ban silver exports. They don't shut markets down overnight. Instead, they introduce friction. Only a limited number of approved firms can export silver products. That slows the flow, increases paperwork, and reduces flexibility, especially for foreign buyers who rely on just-in-time supply chains. In commodity markets, friction matters. Industrial buyers don't wait for shortages to appear on headlines. They respond early. They build buffers. They pay premiums to secure supply. And that behavior changes pricing dynamics even without a visible crisis. For a solar manufacturer, delayed silver shipments mean missed installation targets. For an EV producer, supply uncertainty risks factory downtime. For data centers, reliability isn't optional. So higher silver prices don't stop demand. They simply get absorbed into costs. This is how strategic materials behave. We've seen similar patterns before with rare earth elements, lithium, and other critical inputs. Export controls don't need to be absolute to influence global prices. They just need to introduce uncertainty. And when that uncertainty collides with already tight inventories, it amplifies existing trends. China's role doesn't create silver's repricing by itself. It accelerates a process already underway. Demand is rising structurally. Supply is inflexible. Inventories are thinner than they appear. Strategic friction simply removes the illusion that supply is always available on demand. And once markets realize that availability, not just price, matters, the way silver is valued begins to shift, which leads to a crucial distinction we need to make next. Is this a bubble forming, or something fundamentally different? When prices move quickly, the word bubble is never far behind. It's a natural reaction. We're used to seeing assets surge on hype, speculation, and narratives that outrun reality. In those cases, prices rise first and fundamentals scramble to catch up. But silver's behavior over the past few years doesn't fit that pattern. In a typical bubble, you see excitement everywhere. Media attention explodes. New buyers rush in. The story spreads faster than the underlying use case. Silver has done the opposite. Its demand has grown quietly, driven by infrastructure and technology. Prices have reacted, but slowly, unevenly, and often with sharp pullbacks. That's not what speculative excess looks like. This is what delayed adjustment looks like. Consider how demand is entering the market. Solar manufacturers don't stop buying silver because prices are volatile. Automakers don't delay EV production because silver gets expensive. Data centers don't pause expansion due to short-term market swings. This demand is inelastic. It doesn't respond much to price because it's tied to long-term planning and physical systems. Now compare that to supply. Silver production can't ramp quickly. New mines take years to develop. Recycling can't access most of the silver being consumed. Inventories have already been drawn down by years of deficits. That's a structural imbalance, not a speculative one. Even after silver's strong gains, relative valuations still suggest adjustment is incomplete. The gold-to-silver ratio remains historically high, meaning silver is still priced cheaply compared to gold when measured against long-term norms. That doesn't guarantee future gains. Markets rarely move in straight lines. But it does suggest silver hasn't fully re-rated to reflect its changing role. This is the key distinction. Bubbles are driven by belief. Repricings are driven by necessity. Silver's demand isn't based on what people think it might be worth. It's based on what modern systems physically require. And when markets eventually align prices with necessity, the adjustment doesn't announce itself loudly. It simply becomes the new normal. So what actually changes as we move deeper into 2026? Not everything, and that's important to understand. Silver is still volatile. Prices will still swing. Corrections will still happen. But what has changed is the foundation beneath those movements. For most of silver's modern history, price action was driven by financial mood. Inflation fears would lift it. Rising rates would suppress it. When investor attention faded, so did demand. That framework no longer tells the full story. In 2026, silver sits at the intersection of multiple long-term transitions happening at once. Energy systems are being rebuilt around electricity and renewables. Transportation is shifting from combustion to electrification. Computation is scaling through AI, cloud infrastructure, and data centers. Each of these trends is capital-intensive, policy-backed, and difficult to reverse. That doesn't mean silver prices will rise smoothly. In fact, volatility may increase as financial markets struggle to price a metal that is both an industrial input and a monetary asset at the same time. Short-term pullbacks can still occur if interest rates rise, growth slows, or speculative positioning unwinds. But structurally, silver is no longer waiting for investors to decide its fate. It's being pulled forward by real-world usage. This creates a different kind of market environment. Instead of demand rushing in during crises and leaving afterward, demand remains steady even when sentiment cools. That makes dips shallower over time and recoveries faster. It also changes how price ceilings work. When silver was mostly a financial asset, high prices discouraged buyers. Today, many buyers can't walk away. They adapt, absorb costs, and continue building. That doesn't guarantee extreme price outcomes, but it does suggest that silver's old trading ranges may no longer apply. 2026 may not be the year silver explodes, but it may be the year markets finally stop treating silver as a side story and start valuing it as part of the infrastructure of the modern economy. Chapter 11. Final Reflection. Why silver's role has changed. At the beginning of this video, we asked a simple question. If silver has already had one of its strongest runs in modern history, why does it still feel overlooked? The answer becomes clearer once you step back. Silver's importance today isn't rooted in fear, speculation, or monetary panic. It's rooted in function. Modern economies are being rebuilt around electricity, data, and automation, and silver sits quietly inside all of it, moving power through solar panels, regulating energy inside electric vehicles, and enabling the infrastructure behind artificial intelligence. This isn't a story about excitement. It's a story about necessity. Unlike financial demand, which can vanish when sentiment shifts, structural demand doesn't disappear. Solar farms don't get unplugged. EV factories don't shut down because prices fluctuate. Data centers don't stop expanding because markets feel uncertain. Silver has moved from something people trade to something systems depend on. That doesn't mean prices will move in a straight line. Volatility will always be part of silver's character, but the forces shaping its value are no longer purely financial. They're physical. They're embedded, and they're difficult to reverse. This is why the idea of a quiet repricing matters. It suggests that silver's value isn't being redefined by hype or narratives, but by the slow, relentless build-out of technologies that modern life now requires. The market may take time to fully recognize that shift. But once it does, silver won't need a crisis to justify its price. It will simply reflect the role it already plays in the world. And as 2026 begins, that realization may be closer than most people think. And once that mental shift happens, the repricing process tends to accelerate.